Welcome to our channel, Master Trader 1949X. We are back with another video. Today's video is on the topic, Exchange Traded Funds, ETF. But before we start, we request you to go through the disclaimer shown on your screen. We know that a stock index is a statistical measure that tracks the performance of a specific group of stocks or securities. It comprises of all top-performing stocks. For instance, if a specific stock, such as stock 3, is underperforming, it may be substituted with a higher-performing stock, like stock 4. In essence, because indices consist of top performers, investing in them is a more secure option for ensuring your portfolio stays in green. One can invest in a stock index in a few ways, by buying futures and options, purchasing individual stocks in the index, or through index funds. However, choosing exchange-traded funds, ETFs, is a smart move for several reasons. ETFs give you a piece of many different stocks in the index, spreading out your risk. They're also easier to understand and trade, especially if you're new to investing. Plus, they usually cost less and don't have expiration dates like futures and options do. Let's learn more about ETFs. An exchange-traded fund, ETF, is a collection of marketable securities that track an underlying index. An ETF is a collection of securities such as stocks, bonds, commodities, or a basket of assets like an index fund. It combines the features of different investment options, such as mutual funds and stocks. An investor has a variety of ETFs to choose from. First is equity ETF. It aims to track the performance of a specific equity index, such as the Nifty 50. Example Nifty Bs etc. Second is fixed income ETFs, also known as debt ETFs. Debt ETFs invest in fixed income securities such as government bonds, corporate bonds, or money market instruments. They offer investors a way to access the fixed income market with the liquidity and transparency of ETFs. Example LIC, Nomura G Sector Long-Term ETF, Regular Growth. Third is commodity ETFs. It tracks the performance of a specific commodity or a basket of commodities, such as crude oil, natural gas, or agricultural products. Example gold Bs, silver Bs etc. Fourth category is global ETFs. These ETFs invest in stocks or bonds of companies listed outside of India, providing investors with exposure to international markets and diversification beyond domestic stocks. Example Motilal Oswal Nasdaq 100 ETF. Another category of ETF is Smart Beta ETF. It is an exchange-traded fund that follows an alternative index construction methodology, often based on factors like value, size, momentum, or quality, aiming to outperform traditional market capitalization-weighted indices. Example ICICI Prudential Nifty Low Volatility 50 ETF. ETFs offer investors several advantages. Firstly, they are straightforward to trade, as they can be bought or sold on the exchange with ease. Secondly, they provide transparency, as their portfolio is disclosed daily, allowing investors to track their holdings and performance accurately. Additionally, ETFs replicate the return of the underlying index, ensuring that investors receive similar returns to the market. Finally, ETFs are cost-effective, with lower management fees and expenses compared to actively managed mutual funds. Overall, ETFs are a convenient and efficient investment option for a wide range of investors. Not to forget, ETFs trade on exchanges like stocks, providing intraday trading opportunities and enhanced diversification. They also offer increased options for portfolio construction with various investment themes and strategies. Before we start the main topic, ETF strategy, it's important to discuss the differences between index funds and ETF. ETFs are tradable on stock exchanges. Opt for ETFs with high trading volumes to mitigate liquidity risks. On the other hand, index funds provide liquidity by allowing redemption with the asset management company, AMC, at any time. From a cost perspective, ETFs may hold an advantage over index funds as their overall costs, including transaction expenses such as brokerage fees, STT, GST, stamp duty, etc., tend to be lower. Comparing ETFs to index funds purely based on costs, ETFs typically offer a more cost-effective option. While exit loads are not applicable to ETFs, index funds may have exit loads depending on the fund's policies. The transaction price of an ETF is determined by the market and can fluctuate throughout the trading day based on supply and demand. Investors can buy or sell ETF shares at market prices, which are typically close to the net asset value (NAV) of the underlying securities held by the ETF. In contrast, the transaction price of an index fund is based on the net asset value (NAV) of the fund, which is calculated at the end of each trading day. Investing in ETFs is as straightforward as purchasing individual shares, accessible through any stockbroker app. For instance, when buying ITBs, simply log into your Kite account, search ITBs, and add it to your watch list. Then, tap on it, select the buy option, specify the quantity for long-term or intraday trading, and swipe to execute the purchase. Today we will like to share our strategy for investment in ETF which may be helpful for investors. While we are convinced for investing in ETF, but how to choose the most promising one? One may choose to invest in ETF which is highly volatile with good volume, preferably above 10 lakh. Second condition is ETF should be priced below 200 EMA on 4-hour time frame. Out of dozens of ETFs in India, how to figure out which ETF fulfills our conditions? To shortlist our preferable ETF, we choose charting.com. First, visit the website charting.com. Click on Create Scan under Screeners heading. Change your segment from cash to ETFs. Click on plus or addition sign in green to enter your conditions. Choose Close from drop-down list, then select less than equal to and enter EMA. Change EMA to 200. Remember to change the time frame to 4 hours. Again, click on plus or addition sign in green to enter our next condition. Select volume from drop-down list. Choose greater than or equal to and enter the desirable volume amount, that is 10 lakhs. After entering both the conditions, click on Run Scan. We will get list of ETFs which fulfill our conditions and you can choose from amongst these which one to invest in. For example, we select ITBs from this list. We know it meets both our conditions. So through Kite app we will analyze this particular ETF. We will open ITB's chart on Zerodha. Apply 200 EMA on 4-hour time frame. Reviewing its chart for another instance, we discover that in November 2023 its price dipped below the 200-day exponential moving average (EA) at approximately 31.85, indicating a potential investment opportunity. By February 2024 it surged to 41.59, yielding a return of around 30% in nearly 3 to 4 months. Once more, ITBs has fallen below the 200-day EMA and currently stands at 37.29, might potentially signal an opportunity for investors. It's advisable to average the investment at every 5% decline. For instance, if it decreases by 5% from 37.29 to 35.42, consider averaging it out. By when it touches the white line, and for each 5% increase, book 50% of the quantity. Similarly, book the remaining 50% at a 10% profit. Selecting one ETF might have the potential to yield a 10% return in 2 months and achieve a 50% to 60% return within a year. By rotating among 2 to 3 ETFs with similar characteristics, the overall return could be further enhanced. With this we come to an end of our video. Hope you liked it. Don't forget to like, share and subscribe. Please don't incorporate any strategy before consulting your financial advisor.